Okay, so let's go to chapter 7 now. Okay, so it's about accounts receivable. Let's talk about costs and benefits of selling on credit, and then we go down after that. So trade receivable is amount due from customers from credit sales of products or services, which sometimes in general we call it accounts receivable. Is the same thing. No non-trade receivables, those are receivables that is not related to your business operation. Those are receivables, but not specifically directly related to sales of products. Let's say here it says employee. So if an employee borrows money from company temporarily, that's a receivable, but it's employee receivable, or you call it employee advance. Or sometimes you put some money as an initial security deposit, and it's receivable as a form of prepaid security deposit, and that's non-trade receivable. Sorry. Okay. And let's see. So credit sales, that means you sell some form of goods or services, and you provide some form of credit to your clients to pay your invoice in 30 days, let's say. So that's a credit sales. How much? Depends how much credit sales you want to offer to your customers. Normally you put a limit, and then if they reach that limit, you notify them that the credit sales limit has been passed, and they cannot buy further from you on credit until they pay for the opening invoices. For credit card companies, this is very popular way to sell goods or services and charging credit cards instead of issuing invoice. So in this case, because they are charging credit cards, that means they are issuing sales receipts, not invoice. So the company provides services or goods, print a sales receipt, charge the credit card immediately, and there's no headache to go after clients to collect the receivable. But the merchant service company will charge the business an average of 3% service fee. So if the sales is $1,000, the company gets $980, and the $20 service charge will be applied and deducted from the cash. So the company just gets $980. But still the company is very happy because they don't have any headache in regards to collecting cash, and the credit card company will be responsible to collect from that client in future. But for now, the business is very happy because they got immediate cash on the spot. In some cases, like in my business, when I was using merchant service, I record sales, $1,000, and I record cash, debit $1,000. And the service fee will be only deducted from my account once at the end of the month, combined. So it was not a journalized like this, journal entry like this. It was just debit cash, $1,000, credit sales $1,000. And then at the end of the month, let's say if this is the only transaction I did, at the end of the month, I see there's a debit memo in my bank account, which is a deduction from bank for the merchant service fee of $20. And then for that, I will record a journal entry. I debit $20 for service charge and credit cash $20 because of that debit memo in my bank statement. And if you don't charge the customer and you give the customer an invoice, then this is the journal entry. Obviously, you record the accounts receivable as a debit, and sales will be credited for that purpose. And in case the customer calls you back a few days later and wants to pay by credit card, then this is a journal entry. So accounts receivable will be closed for the client. You charge his credit card. Technically, the business gets only $980, and $20 will be a service charge for business because the merchant service will deduct $20 because of that credit card transaction. So far, so good. Easy up to here. Let's see what else we have. Okay, this is where it gets a little bit complicated. So we have a direct write-off method, which is acceptable for tax purposes, but GAAP doesn't like it. It's a simple non-GAAP method that expenses uncollectible accounts only as they are determined to be uncollectible and are written off. So the reason GAAP doesn't like this, because GAAP says, wait a moment, you cannot sell $1 million in 2021 and then wait till summer of 2022 and say, oh, $10,000 of that $1 million sales in year 2021 cannot be collected and I'm going to write it off. GAAP says that's too late. That's too late to record expense, to record bad debt expense or uncollectible account expense, whichever you want to call it. Bad debt expense or uncollectible account expense. It's too late because that you are recognizing this expense in year 2022 when your actual sales was in year 2021. Remember, in accounting, we said whatever happens in 2021 stays in 2021, right? So that's why GAAP does not like direct write-off method. So what we do for bookkeeping purposes, so we have to do something different. And we call that allowance method. So we use allowance method instead of direct write-off method because direct write-off happens in two different tax period and GAAP does not accept that. But allowance method is good because GAAP says I like it because you sell something in year 2021, $1 million of sales, and then you recognize an estimated, not actually, but estimated. You recognize an estimated bad debt expense in year 2021, and you put a T account called allowance for uncollectible account, so something like that. And that will be a T account available to you to write off anything in future. But the thing that is important for GAAP, it says you record the bad debt expense exactly in year 2021. You can write it off 2 years later. That's fine. But you can not record the bad debt expense anything outside 2021. Up to here, are we good? So in regards to allowance method, it's a method that estimates uncollectibles as a portion of total receivable and establishes an offsetting contra account. We call it allowance for uncollectible account or allowance for doubtful account. So it's an allowance account, technically. How you call it, that's fine. Allowance for doubtful account, allowance for uncollectible account, either way is fine. So when you have that contra account, so your accounts receivable, let's say in this case is for the $425,000, your allowance for uncollectible account shows a credit balance of $25,500. So net accounts receivable in the balance sheet shows $399,500. This is net realizable value of accounts receivable. That's the amount of cash expected to be collected on outstanding accounts receivables, less allowance for uncollectible accounts. So 425 minus 25 gives you 399.5 net realizable value or net accounts receivable. So how much that allowance should be, you have to estimate that. You have few ways to estimate. One way is estimating based on credit sales for the whole year, which in that case, it's not in your book, this part that I'm saying. If you use percentage of credit sales, that's fine. Credit sales of whatever you sold during last 12 months combined, let's say 3%, 2%, something. If you use that, then anything in allowance, T account balance left over from previous period, doesn't matter how much it is. You don't need to consider that, it's not important. However, if you decide to use the one that your book is showing here, this is another method available. You go with either percentage of accounts receivable or using aging of accounts receivable. Percentage of accounts receivable and aging of accounts receivable, both of them are the same thing. The only difference is in the percentage of accounts receivable, it's easier, but percentage of aging accounts receivable, you need to do a little bit of data collection. And if you use percentage of accounts receivable to calculate your allowance account, then remember, then it's so important to know how much allowance T account has in its ending balance from last period, because you need to consider that. However, you don't need to consider that if you use percentage of credit sales. You might say, what's the difference? Why I don't care about the allowance leftover balance from last period under percentage of credit sales, but I need to be worried about it under percentage of receivable? There is no precise answer to that, but I came up with an answer. The reason is under percentage of credit sales, your credit sales is few $1 million. It's a very big, large number. And that's why when you go with the percentage of credit sales, a few $1,000s left over in the allowance T account from last period doesn't matter. You don't need to use that in your calculation. But if you use percentage of accounts receivable or even step further, percentage of aging of accounts receivable. Then you are looking at a small accounts receivable balance. And then you are estimating based on that. Since you are considering such a small accounts receivable balance and you are estimating based on that, then any balance in allowance account left over from last period should be calculated into your calculation before you decide how much debit or credit to recognize your allowance. And this is the percentage of aging. That means under aging, you need to say, okay, how many people, how much dollars is not late? How much dollars are late, 30 days or 60 days? How much is late between 60 to 90 days? And how much is late between 90 and over? So, and then you estimate a percentage of chance that you cannot collect this amount, 1%, and then chance goes higher, 5%, and then 15%, and then much higher if it's over 90 days. And then you multiply that, you get a dollar amount, you add them up, you get a allowance balance required of $25,500. So this is what you exactly want in your allowance account. And because you use the percentage of accounts receivable, that means you have to make sure you know how much is left over in the allowance T account from previous year. So let's say here, once the estimated amount for allowance account is determined, a journal entry will be needed to bring the ledger into agreement. Assume that company ledger related on revealed an allowance for uncollectible account credit balance left over from previous period, $10,000. And you just here calculated that you want 25,500. And you, because you are using percentage of accounts receivable method, then you are exactly certain what you want. Therefore, you have already 10,000 existing in the allowance left over from last period after writing off whatever is necessary. So this year on December 31st, you only need to add another $15,500 to the 10,000 existing balance to get to the point that uncollectible account expense or bad debt expense debited only for $15,500. So you can see here why it's so much important to understand and remember that if you use percentage of accounts receivable, make sure you remember that you need to consider what is left already in the account. And because of that, how much you need to journalize on December 31st. Any question, please? Very important. And you will be tested on this. Okay. So just see if you remember or not. I said it's not in your book. I said if you use percentage of credit sales for the last 12 months to determine how much you need in the allowance T account, then this $10,000 existing balance, it will be absolutely useless. You will not, you don't need to use that number anywhere in your calculation. I give you an example. Again, it's not in your book. So let's say percentage of credit sales. If your credit sales is $1 million for the last 12 months, and you believe, let's say you believe 3% of that $1 million credit sales will not be collected, and you multiply 3% by 1 million, the answer is $30,000. Yes, I know you have $10,000 in the allowance, but that's not relevant. So I'm going to do journal entry here, $30,000 debit, $30,000 credit. So bad debt expense debit, 30,000, allowance for uncollectible account credit, 30,000. Okay. Now, here you are, here is showing why you need to debit only 15,500, because it says you have $10,000 existing balance. You only need to do additional $15,500 of journal entry in order to get your desired balance, because you are using percentage of accounts receivable method. In order to write off something in future, let's say in summer of 2022 or 2023, whatever. So in that case, you finally decide that this is not collectible. So you credit allowance for $5,000, and you debit allowance for $5,000 to reduce it. So the allowance here will be debited for $5,000, and you credit accounts receivable to reduce and close that existing balance that will not be collected as of that moment. So if you look at the write-off before and after, so before write-off, your accounts receivable was, let's say, 120 minus $11,000 allowance. The net receivable is 109. After write-off, your accounts receivable goes down by 5,000. Your allowance goes down by another 5,000. Therefore, your net accounts receivable is still same thing, 109. So you see, nothing happens. You just write off, receivable goes down, allowance goes down, and you have the same results at the end. If after write-off, the customer realizes that he made a big mistake and he comes back, he says, I'm sorry, let's work together again. I'm gonna pay a portion of whatever you wrote off, and let's be friends again and do business again. You say, okay, how much do you wanna pay? He says, I can, instead of 5,000 write-off, but I can, pay you $1,000, let's say. You say, okay, no problem, give me $1,000, we do business again. So he gives you $1,000 and check, but before you deposit the check, you do a journal entry. You reverse whatever you did before. So you debit accounts receivable this time, and you credit allowance for bad debt expense, allowance for uncollectible account, credit for $1,000. Now you have an accounts receivable existing balance. Then you go to bank and you deposit the check, and that will be deposit cash debit, and accounts receivable that you just created in here for the customer, now it's closed. So previously written off collection needs 2 journal entries. Make sure you know that for your exam. So one of the liquidity ratios that you can consider as a ratio that shows the how good the company is collecting accounts receivable is accounts receivable turnover ratio, which is net credit sales for the whole year divided by average net accounts receivable. And why you say average? Because this net credit sales belongs to the whole year, last 12 months. You cannot just use accounts receivable on December 31st. So you say last year, December 31st accounts receivable plus this year, December 31st accounts receivable divided by 2 will become an annual average of accounts receivable. So now here is annual and here is annual. So apple to apple, you divide net credit sales by net average accounts receivable, and that gives you a number, let's say 10. And that will become your accounts receivable turnover ratio. That means your accounts receivable during the year has been turned over and collected completely for 10 times. But you want to know how many days it takes you to collect in average in your company, and to see how good you are in creating liquidity and cash flow. You say, okay, I need to calculate days outstanding, which is 365 days in 1 year divided by accounts receivable turnover ratio of 10 times. And that gives me 36.5 days average time to collect on your receivables. It might be good, it might be not good that much. You have to compare either to your last year operating activities to see how often you collect, or you can compare this to another company's accounts receivable turnover ratio to see how good is the other company to collect accounts receivable, how fast, and then understand which one is doing better. So you can use a liquidity ratio just like this also in your presentation. Any question? Okay, you have also note receivable, which is a written promissory note. Your client is signing it and promising to pay your money back, including interest. It has a maturity date, and it shows what is the principal of the note and what is the interest on the note. To calculate the interest, you have to calculate the principal times interest times time period, which is, let's say, 60 days out of 360 in a year. And that gives you, let's say, $20 of interest. So you record the note receivable in this case, because the accounts receivable was supposed to be paid in 30 days and the customer was not able to pay. And you ask the customer to sign the note because you're going to close the accounts receivable and convert it to note receivable. So the client will sign the note and he gets another 60 days time to pay this note, but this time now the client has to pay interest. So 12% annual interest rate on the note, and you establish the note, debit note receivable, and you close the accounts receivable in this scenario. On the maturities, let's say 2 months later, after maturity date has been reached. So the cash should be collected from customer with a check, let's say. So you get the cash, $10,300. Out of that, $10,000 is the note receivable that you need to close, so credit note receivable. And $300 is the interest income that you need to record because you got $300 as form of interest. If the company dishonored the note after 60 days, that is bad news, right? So in this case, you respond to the borrower that you are going to record the interest income, you are going to close the note receivable, and you are going to open an accounts receivable again, but this time is $10,300. And you will tell them that you will go after another month to collection to pay for this, to recover this $10,300 some way, somehow. This one, it says, how about if the end of the year, here you see you record the note receivable and close accounts receivable, that's fine. But now you have a note, but right 30 days later at the end of the month is when you prepare your financial statements for the month. And that means you need to recognize the interest that you earned already in these 30 days. So at the end of the month, before you prepare financial statements, you need to recognize the interest receivable of $100 and your interest income of $100 because of this note. And then you prepare your financial statements. If you are not going to prepare financial statements, then you don't need to recognize anything at this point. There is no rush. So if you record the 1 month of interest already, so a month later, let's say, 2 months later, whenever you are collecting this note receivable, including interest, because you have already $100 interest receivable here, make sure you close that. You close the note receivable, you close the interest receivable, you only record $200 of interest income because you already recorded $100 here, and you debit the cash into your bank account. Deposit the cash, record the proper interest income, and closing of those two receivables.